Hi everyone, my name is Alexis Cherry. This is my final project on Texas Instruments Incorporated. Pretty much the contents of this presentation, I'll go over the background of the industry, firm history, talk about the business model, do the financial statement analysis, and talk about the ratios using the reformulated financial statements, talk about my evaluation methods, and my recommendations. So Texas Instruments operates in the semiconductor industry. Semiconductors are known as integrated circuits or microchips. They're a component of electronic devices that enable advances in communications, computing, healthcare, military systems, transportation, countless other applications. Many aspects of today's advanced world derive from the evolution of semiconductors and from leaders of the industry such as Intel, Samsung, and Texas Instruments. There are three different categories that a firm can identify as: fabless, foundry, or IDM. A fabless firm focuses on design only, whereas a foundry focuses on manufacturing only. An IDM does both of those. It's also known as an integrated device manufacturer. Intel and Texas Instruments are both IDMs, and even though they identify in the same category, they serve completely different purposes and clients. For example, Intel primarily develops processor technologies, and Texas Instruments supplies digital processors, calculators, more. This is a global industry. The U.S. sector of the industry is the world leader, and it's sparked by rapid technological change, and we see trends of high cost in research and development. A little bit of history about Texas Instruments. It started as geophysical service in 1930. It was a petroleum exploration firm, but because of the volatility, it reorganized with Coronado as the parent company and Geophysical as the subsidiary. A few years later, GSI was bought back from Coronado, and they started focusing on military manufacturing, producing electronic equipment for the U.S. Navy and Army Signal Corps. Years after the war, the geophysical division of GSI was performing really poorly, so they reorganized yet again into General Instruments. But in the same year, it was renamed to Texas Instruments because another company had already taken the name. Texas Instruments is known for the production of the first silicone transistor and the first portable radio, which is here and here. It's called the Regency radio. That was in 1954. They're also known for the first commercial IC computers that use silicone ICs, the first handheld calculators. If you've ever taken a finance class, you've probably used a Texas Instruments calculator. The Speak and Spell, a single chip microprocessor, and multimedia video processor. The business model I took out in 4 key aspects: the CVP, which is the customer value proposition, the job to be done. They design, manufacture, test, and sell analog and embedded processing chips. They are focused on affordable, reliable, and efficient semiconductors, but their main target market is in the automotive and industrial markets, and the products they focus on are their analog and embedded processors. As far as their profit formula, in the past couple of years, they've seen a decline in revenues, but also a decline in cost of goods sold because of the type of fabrication they use. It costs 40% less to manufacture compared to its competitors, so it's kind of got that advantage going for it. Key resources: silicone is widely used, the most widely used material in the semiconductor industry. It's very cheap, it's easy to process, it can withstand high temperatures, and it's just really abundant. The other key resources are human capital, innovation, and patents. Most of these companies wouldn't be as large as they are without their patents or that human capital inventing those new technologies. Key processes include their manufacturing and designing. They have a strong foundation for manufacturing and have differentiated technology. As for the ratios, the operating profit margin I found was 33%, was about 13% higher than the industry average. Sales profit margin, 34%. This ratio is just higher due to the addition of other comprehensive income that doesn't come from the company's own income. Net profit margin, 33%, actually closer to 32.5%, lower since I've taken out the net financing expenses. The capitalization ratio is 0.64, which means the company's healthy, forgoes a large debt burden. Net borrowing cost is 0.31, tells us that we're not spending very much on borrowing. It's not very surprising for a company as large as this and in this industry. The return on net assets, financing assets, is 0.88. They're using financial assets efficiently, effectively, and last but not least, the most important, operating probability came out to 4.67. The firm is utilizing operating assets well, but if it's looking to increase its ratio, it should definitely increase its sales. As for my valuations, all three valuation methods came up with very similar valuations. For the comparables, I used Micron, NVIDIA, and Microchip Technology. So you'll see the comparables, 178 per share, $178 per share for DCF, discount cash flow model. For residual earnings, it was a little bit lower, $176, a little bit more reliable than the last two. And the last residual operating income came out as $163 per share. The market is currently selling Texas Instrument for $129.63. So my valuations are actually valuing the company way over what the market is pricing it as. So therefore, my recommendation is to buy. I'm very convinced to recommend this as a buy since it's clearly selling at a steal at the current moment, and I don't think it would disappoint in the long run. Performing in an industry that's highly competitive and derived from rapid change, ability to adapt and innovate, and investing extreme amount of funds into research and development is not to be taken lightly. I think they've proved to be a company of longevity and will continue to satisfy investors in the future. Thank you.